You're a very long-term investor. You're offering an enormous amount of capital to global markets. I'd love to get your take on AI. Is it just, the flavor of the year, or is it something that's really going to drive us, like the internet has, long-term over decades?
It's a great question in a time where there is a lot of buzz about it. But fundamentally, all businesses need to be more efficient. And one of the ways to make human more efficient in their procedures and make companies and make software more efficient is empowering it with AI. The key fundamental thing that happened is the strength of software coped with and coupled with the strength of hardware, which is available now. And that opening up and the availability of data, those three factors getting together and proof of concepts flowing in indicated that there is a big use cases across the industries. So we believe it's a very real thing. In fact, we in the QIA, we're a very long-term investor, very, very sizable as well. From time to time, we assess the long-term themes that we should spend time on, and AI was one of them a few years ago. We started investing heavily in things like data centers. So in addition to investing on highly volatile or kind of higher risk return businesses that we really like to invest in, we do a lot of investments in those as well. But you could also invest in a lot of things that are more infrastructure-like and would fuel AI.
So, Saira, how do you look at it? Obviously, we all think about the end user, but also Mohammed is one of the large investors that's going to drive this sector. When you look at it as a CIO, what do you find interesting in terms of, industries that it's going to affect? Software, hardware, where do you look to put money to work?
Well, beyond the traditional AI plays, the other thing about AI is that it works off a ton of data. So these large industries like healthcare, financial services, R&D in healthcare, where there's tons of data, financial services investors like us who can look at our trading data and our client data and look and use AI to make us more productive and more solutions-oriented for our clients. I think it's going to be important across a host of broad industries. But like any newish sector, it has its fits and starts. So you've had this period since February 2023 where if we go back and think about that, everyone was worried about a recession last year, and instead we got February 2023 where AI became more widespread and the markets took off. So we've had that period of sort of euphoria, very limited supply of stocks, NVIDIA, Microsoft, not a ton of companies that we can invest in publicly. That's why those stocks have done so well. And now we're seeing a bit of a consolidation phase. You look at NVIDIA, which has been down over 10% in the past few days. But as I mentioned this morning, we're just back at early July price levels for NVIDIA. So this isn't exactly a massive downturn for the stock. But there will be these periods of consolidation where it gets somewhat overbought, but the long-term trends for artificial intelligence, that increase of productivity and revenue boost for companies, I think is here to stay.
Yeah, $430 billion in market cap was wiped out over the last 3 days. I think it's still up. It was up at least when I left the office an hour ago. In terms of the investment opportunities, are you finding more, Mohammed? Because as Saira mentioned, at least in public markets, there are only a few, as you can see by the capital formation, there are only a few opportunities that investors can go to.
To add to another point, actually, not necessarily the new market cap created is new opportunities. A lot of that is actually new players eating up legacy existing players. So to answer your question, I think, first of all, we as a long-term institution, we're conducting constantly deep reviews on what kind of businesses we own that could be negatively impacted by the long-term new themes as we see them. So one is looking into how could we readjust our portfolio and mitigate it against some of those themes. AI is one of them. In terms of availability of options, there is the public space where there is few names really that address them directly. But in the private space and some of the public space as well, you find very interesting applications where it's AI empowered. For example, we invested in a business called Radiology Partners. It's basically a medical services business that utilizes AI to make radiology assessments better. For example, it's seen that radiologists, there's not a lot of them, sometimes difficult to find a radiologist in time. So having some software that enables you to aggregate all the know-how and data, historical, and utilize and make radiologists be able to see 20 scans in an hour instead of being able to see 4, for example. So in addition to finding new hardcore AI, we're looking into other applications that could be empowered by opportunities or businesses that could be transformed with an element of AI.
It's interesting. An interesting tangent to this is public investments versus private. And last year when AI really took off, we also saw an explosion in interest, at least, in private investment, certainly in private credit, even for retail investors. I talked to a guy who was running a platform that was going to allow retail investors to invest in private credit. I thought maybe that's a little bit above their pay grade, but it's happening, right? How do you look at the asset allocation between private and credit in portfolio construction?
Sure. Well, I think the 60-40 equity fixed income portfolio will evolve to a 50-30-20, 50 equity, 30 fixed income, 20% alternatives. Alternatives provide not only lack of correlation with other asset classes, but more diversification from the other asset classes. I think 3 asset classes and alternatives are very interesting: farmland, infrastructure, and private credit. So first, starting with farmland, it's a great inflation hedge. Over the past 30 years, on an annualized basis, farmland has outperformed inflation by 8.5%. Obviously, a key issue these days with inflation staying sticky. Looking at infrastructure, not only the tailwind from building additional data centers and different ways to meet our AI needs, but also the shift to renewables. Estimates show we'll be spending $200 to $500 billion a year on electrification of our grids, also increasing our grids by over about 50% over a number of years in order to meet the demand for renewable energy. And finally, onshoring of all kinds of supply chain as the U.S. relies less on other areas of the world. So infrastructure is a multi-year play in alternatives, public and private infrastructure. And then private credit, another area where investors are looking because it's been more resilient in economic downturns. And also people sometimes push back on, what's really going on with private credit? What's the quality there? Is it just a lagging asset class, that'll just catch up with high interest rates and we'll run into problems? We're not seeing that in the data at this point. So private credit still looks very resilient to us.
Mohammed, your remit is the Americas, but you also are the second highest ranking member on the investment committee, so you're overlooking the whole global portfolio. Give us the 30,000-foot view of your portfolio.
The good thing about us is we have only one customer, which is the state. So when you have one customer, you don't necessarily need to be super open in terms of your allocation policies. But to give you a sense, about half of the book is in the public space. And the other half is more kind of privately held positions, including things like real estate and infrastructure and alternative. We like this combination because we'd like to play to our advantage of being able to extract more illiquidity premium, and we take a little bit, occasionally, more execution risk and development risks, and having a sizable exposure into the private space enables us to do so. Over the past few years, we tactically increased our exposure into credit. It was an interesting time for us to do more on the credit, in a time where private markets were a bit shut. And we still see more opportunities in the private credit space, despite because the banking system is in a complicated position and continues to be.
Clearly you have a very long investment window, but what are we talking about? 5, 10 years, or even further out?
The fund has, by design, the state does not require us to bring back immediate cash flow. So the immediate outflows expected from us is 2030 plus, and it's a systematic dividend back to the state. This enables us to kind of plan for longer term. However, every investment we do, we have a time frame attached to it. We have annual assessments to every investment, and then we kind of ideally would probably underwrite a 5 to 7 years, what we consider long term. We could extend if we believe that reinvesting, there is no available reinvestments of same quality. So we could easily extend that time horizon to much longer.
I want to
also enables us enable us to allocate to strategies such as growth equity, technology, and healthcare, which could be much longer than 7 years. But we believe that if we underwrite it and we invest in the human capital and have the right investment teams, it's justified to stay longer and enables you to get better multiple return and better return metrics over the long term.
I want to talk about the consumer, and it's interesting because you can look at the consumer. I normally do sort of at a medium term, right? But Mohammed, you're looking at these issues over a much longer term. Saira, you mentioned consumer weakness as one of the drivers of the market right now. And of course, we've seen since the pandemic, certainly most consumers spending all of the stimulus money they got, driving down the savings that they have, and now the lower two quintiles at least seem to be struggling. We even hear reports of wealthier consumers, switching down from, say, Whole Foods, for example, to Walmart. That was in Walmart's earnings report recently. And the last couple of days, we had reports of Winnebago not meeting their sales forecast, pool installation not nearly as high as the largest pool distributor had expected. So what do you see in terms of the consumer weakness right now, and how long do you think that lasts?
Well, sure. There's three factors that we're looking at for the second half of this year, and that's the economy, elections, and earnings. So the first one in the economy, two factors in there that are important. That's the consumer and employment markets, because those have been some of the key drivers for this economic cycle. We are seeing cracks with the consumer, not only an increase in delinquencies, fast food restaurants discounting, retailer foot traffic weaker. Retail sales has been missing estimates for the majority of this year. I think consumer is starting to slow. Employment markets have been mixed. Payroll data has been strong, but if you look at other data points for the employment markets, they've been becoming weaker. You look at unemployment claims, they're almost at highs for this cycle. So we are seeing employment markets start to slow. Usually people are more comfortable spending when they're comfortably employed, so those kind of go together, and I think that would be what brings us into a recession at some point. I think a recession is a when, not an if at this point, but it's not going to happen immediately. So it'll take some time, but we are slowly getting there. Elections is another key driver for the second half of this year. Huge year for elections around the world. 77 countries, 60% of GDP going to the polls. We've already seen volatility from South Africa to India to France and other key non-U.S. markets. In the U.S., of course, we're approaching the second half election. Good news, though, is even though volatility picks up in an election year, markets actually tend to perform well, which is what we're seeing. And third is earnings. Earnings are the key driver for the market. We're just approaching second quarter earnings, and they look strong. So that's also the good news. Earnings should be up from a consensus point of view, a little bit over 10% for the second quarter. So news is good now. I am more concerned about the medium term, though, as the consumer slows, as the job market slows. I think we will slowly move to a recession. A key question, of course, is will the Fed save us or not? I think it's a tough balance for them.
Well, what I thought was interesting, Michelle Bowman from the Federal Reserve was speaking in London either last night or this morning. I saw the news on the Bloomberg this morning. And she was saying that restrictive immigration policies could strengthen the labor market, right? Because we've had such an influx of immigration that there's been so much supply in terms of labor. And I immediately thought about your election volatility, right? Because one presidential candidate is likely to restrict immigration more than the other. Is that a game changer? Do you think that could, change the way the U.S. economy actually goes, the November election?
I think that what's been challenging about the labor market post-COVID is there's been so many factors that have caused it to behave the way that it has. So where participation rate has been weaker than we wanted it to be. Older workers have not come back into the labor force. We don't know. People talk about immigration. How does that impact? I go back. I think there's so many factors that have confused people with this labor market. It's hard to point to one. If you look at the presidential election in general, what earnings are going to drive the markets. While we usually see volatility going into the presidential election, usually the markets calm down afterwards, especially if the outcome is gridlock. And, then sort of the president will have, sort of less government impact on the markets and more fundamental impact for the markets, which is a positive for investors.
Mohammed, you can look at obviously the labor market the way we're talking about it right now is too short term for your investment horizon. But if I think of a longer term consumer trend, I think of India right away as, a rising, growing middle class. How do you look at the consumer globally?
There's globally and there is regional. So in addition to the middle class rising into a lot of major markets, a lot of developed markets as well, you also have generational changes of the way we consume. So compared to 20 years ago, the style of consumption now is a bit different, and compared to 50 years ago, it's started quite different. And I think there was a little bit on excess boost post-COVID, where people started now putting much more on services than they're doing goods. And in goods, people are focusing a lot on things fueled a little bit by things like social media and what kind of the consumer behavior is focusing on, like lifestyle and things around, healthier consumption, a lot of the trends. So in addition to your point of middle class, and there is some other more fundamental generational trends that are happening.
Ozempic, by the way,
one of them. I think that the market cap of the business is getting quite well, so there's a lot of users around town. So all those kind of consumer behavior is just changing. So in addition to a weaker consumer now, as we see interest rates, you also have generational changes that happen from time to time in the way we consume. Both has to be assessed at the same time.
How do you look at the U.S. consumer? And does, if we do get a continually softer labor market and inflation continues to trend down, how much does the Fed matter to you at the QIA? Like if they cut once or twice this year, does that matter?
I mean, it matters to any investor. This is the key fundamental driver for pricing and how you price assets. At the same point of time, the cost of interests the consumers would pay over the credit cards and various goods they acquire is quite different than it was 2 years ago. Now, I'm not suggesting what is better in terms of levels. I think the Fed did the right thing to kind of, the biggest enemy for us is inflation, which has come back significantly. Now it's that how long it's being kept. And you look in terms of the consumer quality, the strength of the consumer, you see a lot of fatigue, weaknesses. A lot of the indicators that are around consumer quality and strength, whether it's in the credit card, the automotive, and a lot of the variables. So there's definitely a weaker consumer coupled with a strong labor market now. So as that become weaker, a little bit labor market, you would immediately should expect to see significant impact on consumer strength.
You expect, Saira, a recession, as you said. You expect the Fed to cut rates initially in September, which I think is interesting because it's right before the election, and the Fed, I think, wants to be less political or as apolitical as possible. Why do you think they'll do it in September, and will they be forced to continue cutting rates? Because that would be bad news for the market, right?
Well, the Fed tends to do less, not more in an election year for exactly the reason that you stated. We've said September at the earliest for interest rate cuts, and because what we need to see is we need to see multiple months of moderating inflation. We just saw probably our first month of CPI, missing estimates, PPI, coming in at or under consensus. And then, of course, this Friday we have PCE, so we'll see what that looks like. I think the Fed doesn't want to risk losing credibility by cutting rates too early, so the safer bet is that they stay on pause for a while longer, until they either see inflation start to moderate or the economy slow. And that's sort of the timing issue there. When will the economy really start to show more significant signs of weakness? So that'll probably determine your first rate cut. If it's not September, it's probably post the election, likely in December. Mohammed did bring up an interesting point on generational behaviors, and I think also another sort of important market trend is the trillions of dollars that's going to transfer from one generation to the next, how the next generation will be thinking about money, and also, of course, the trillions of dollars that's still sitting on the sidelines for people who were waiting for that recession in 2023, sitting in their T-bills, sitting in cash, earning 4 or 5%, that have now missed out on this rally and are figuring out how do I get back into the markets, particularly equities.
You'll be able to take, I heard Ed Ardeni recently say that the baby boomer generation has $75 trillion in household assets minus liabilities. It's massive. It's half of all of the U.S. household assets. You'll be able to take advantage of that. How do you think about that, Mohammed? Because that generational shift is going to be massive.
I think in addition, we are a significant investor on consumer businesses. We invest in travel and leisure businesses as well. So, we also invest in asset managers actually with time. And we've been investing a lot of the IRAs and been focusing on that as well. So there is a significant trend that we're trying to capture through investing in financial institutions. At the same time, businesses that will be net beneficiaries out of that consumer behavior.
I want to talk a little bit more about the election and how you see this. Saira, Larry Summers thinks that Trump's policies will be the most inflationary that he's seen from any politician in his lifetime. I feel like Larry Summers was being a bit alarmist in that sense, because even though Trump's policies are going to be a different scale than Biden's, he still wants to put tariffs on China. He still wants to restrict immigration. So how concerned are you about the election?
I think it's shorter term. Of course, the election will cause volatility, but I think it's hard to pinpoint the cause of inflation on any one person or any one policy. Just post-COVID, the unwinding of supply chains has been inflationary. China, if it really starts to reopen and recover, that could be inflationary in terms of commodity prices. Onshoring closer to home will continue to be inflationary. There's And consumer spending has been inflationary, just people wanting to keep spending money. You mentioned the trillions of dollars that went to the consumer during the pandemic. So there's so many reasons that inflation will continue to be sticky. Also, just looking back at history, if you look at inflation prior to the GFC, going back about 50 years versus post the GFC through the pandemic, inflation was structurally much higher for the decades pre the GFC, and so were interest rates running sub 6%, a little below 6% for the 50 years pre the global financial crisis versus sub 1% post the global financial crisis. So, if you look at the normal world, higher interest rates and higher inflation were basically the norm. That's why I think it's here to stay, and I don't pinpoint it on one presidential policy or one factor continuing or not. I think it's just really we're going back to, I guess, not the new normal, but the old normal.
I want to finally ask you, Mohammed, what you think about the U.S. deficit from the QIA's point of view. I notice we're spending $100 billion a month now on interest rate servicing. So we're spending more on our debt than we spend on the military. It's going to be $1 trillion a year and start to eclipse that quickly. Does it bother you?
It definitely bothers all investors investing in the U.S. But I think we're assessing and thinking about all the time, and all the investors the same thing, is that what is the solution? What fundamentally is changing in terms of how do you deal with the debt with time, and how do you deal also with the fiscal discipline across the various states within the U.S.? You see a lot of great cities need to be probably rethinking about their positioning on a global stance and within the U.S. itself. So it bothers. I don't have the solution, but I think with time is thinking about the actual long-term approach is super important, both in fiscal discipline and on dealing with the high level of debt.